Many of you may have holdings in your portfolio that have done a little bit better than you expected a couple of years ago. So do we let our winners run and continue to see them accumulate gains, or do we want to hone that back and rebalance by being strategic? So we're going to be talking a little bit about strategic allocation versus tactical allocation, and when that may be a good thing to be looking at things tactically versus strategic. And please feel free to stay to the end, because we'll be covering some things in specific that we see doing well in the upcoming year. This past year, a lot of people have seen growth in certain parts of their portfolio, especially in some of the largest, most popular companies like Nvidia. So what if you have a lot of Nvidia in your portfolio and people are asking you to sell it? Should you be selling your Nvidia? Well, if someone is looking at things from a strategic standpoint, maybe they should, because Nvidia could be causing your portfolio to be out of balance and could be causing too much risk. That's if we define risk as volatility. But there's another way to define risk, and that would be the way that Warren Buffett defines risk. And he says that risk comes from not knowing what you're doing. And it's always important, we want to remember that stock market volatility is, according to Warren Buffett, not a measure of risk. Just because a stock goes up or down by 5% doesn't make it any riskier than a stock that goes up or down by 2%. The risk comes from buying things at a price higher than what it's worth versus buying things at a price lower than what it's worth. If you're buying something for less than what it's worth, then you're typically going to come out okay. If you buy for more than what it's worth, it's usually not going to be good down the road. So we want to make sure that we're buying things at a good value. Price is what you pay for, value is what you get. But when people think of how they're allocating portfolios, they usually either think of things strategically or they think of things tactically. And so when we're thinking of things strategically, usually people are doing this in a way where they don't have to think about it as much. It's a no-brainer way of doing things. You don't have to think about it. It's a hands-off approach. You buy it and you hold it, and you might rebalance it from time to time to make sure that the allocation stays the same, because some things that do really well may not do as well in the future. Some things that aren't doing very well may do better in the future. And so we're balancing that out so that when it stays the same, the volatility isn't as much. So it's good for somebody that has a long-term time horizon, and it's better for people that get really emotional and they can't buy when things are down and sell when things are up, so they put themselves on a schedule so they do things automatically. A tactical allocation can be better if you know what you're doing, and it involves possibly trading more often. With Warren Buffett, he doesn't trade that often, but you could say Warren Buffett is somewhat tactical. Anyone who's holding $325 billion in treasuries right now, most people who are usually 80-90% in equities, if they hold over $325 billion in treasuries, over a third of the portfolio, that means that they're being tactical, and they want to be a little bit more conservative right now, have fresh powder in order to buy in the future. So being tactical could be good for a shorter medium-term horizon. It requires more control over impulses and demands a little bit more investing expertise. So should we be strategic or should we be tactical? These are some strategic models that come from Morningstar for people who are really aggressive, that may want to have about 90 to 95% in stocks, to really conservative where they want to have bonds up around 70 or 80%. Now, if you have 100% in bonds, you're actually taking on more risk from a volatility standpoint than if you have 70 to 80% in bonds, because there's times when bonds go down in value, like in 2022, when interest rates go way up, bonds come down, and 2022 was about the worst year we've seen in bonds in about 100 years. We want to be greedy when others are fearful. We want to buy when other people are selling and sell when other people are buying. And when things are really high and people are euphoric, we want to be selling to those people. When people are really panic-stricken, we want to be buying from those people. But most people don't do that. A lot of people follow the herd. If you sell when people are too euphoric, you're going to do well. If you buy when people are too pessimistic, you're going to do well. But most people don't do that. As Buffett says, you want to buy where there's a margin of safety. If the intrinsic value of the company is going up and you're buying for less than the intrinsic value, you're going to win in two ways. You're going to win by the value of the company going up. You're going to also win by buying below that value. So you win in two ways. People right now are overly fixated on the largest, most popular companies. And so market cap weighted indices are doing very well. That's where the largest, most popular companies are starting to dominate the indices. And this shows how that's done very, very well over a good period of time now. But there are times when equal weighted outperforms or even revenue weighted outperforms. And those are times when the biggest, most popular companies of yesteryear go out of favor and new things come about. And so we saw this in the early 2000s where small caps did very, very well after a period where the large caps did well. And so we might see that again. And so if you're acting tactically, you could decide to shift more towards small companies. Or if you're acting strategically, you're going to always have some in small companies. But if you're acting strategically and small companies haven't done well for a long time, then the large companies are going to get bigger and bigger and bigger part of the portfolio unless you're rebalancing it. And you're making sure to keep the small companies there. If you're acting tactically, you can put more towards small when small starts to do better. It may be that value-oriented companies haven't been doing well for a time. And actually that's the case right now. Growth has been outperforming value. A lot of times we see good values by buying those things with big dividends. It's hard to fake dividends. It's easier to fake earnings than it is dividends. But if they're paying out those dividends, those are really hard to fake. So if we buy those companies with the biggest dividends, sometimes that'll do very, very well. We can see a period here from 2009 through 2017, 2018 where the things that paid the biggest dividends did the best. That has not been the case over the last 4 or 5 years, but it may be the case in the future. If you have a certain part of the portfolio in that and you're being strategic, you keep that invested there. If you want to invest into what's going to do the best and you know it's going to be like 2022 again, you put everything here. But we don't always know that, so we want to be somewhat strategic at the same time we're being somewhat tactical. You determine how much tactical you want to be versus strategic. And of course, we mentioned that Buffett has over $325 billion in treasuries. He is allocating an extra amount toward treasuries because he wants to be able to buy later and doesn't want to be buying when things are high. Warren Buffett likes to say that diversification is protection against ignorance. It makes very little sense for those who know what they're doing. He believes that investors who have a deep knowledge about things can overweight towards certain things where they see things doing better in the future. And so if we see high inflation, we're concerned about high inflation, we might want to allocate a little bit more toward things that are going to benefit from inflation. If we're concerned about recession, we might want to allocate a little bit more toward things that are going to do better in a recessionary environment. So gold can benefit in an inflationary environment and a recessionary environment. So if you're concerned about those two things, you might want to look at something like gold. Also, things like Bitcoin are going to benefit in case we see the dollar devalue versus what it's been in the past. And dollar might be getting stronger versus other currencies, but we might be devaluing in general. If we have a little bit in Bitcoin, that can be a good hedge against the dollar devaluation and devaluation of all currencies around the world. So a lot of people have been chiming in about how much you should be invested in Bitcoin. BlackRock wrote a paper a few years ago that said the very best percentage to own in Bitcoin for the last 10 years was about an 83% allocation. But I don't see a lot of people wanting to put 83% of their net worth in Bitcoin. That might be a little high. ARK Invest, that's run by Kathy Wood, said that right now they feel a 19% allocation is the best allocation for Bitcoin. A lot of other companies like WisdomTree and Yale, they're saying that WisdomTree says a 5% is optimal. Yale University a couple of years ago said a 6% is optimal. Fidelity says 2 to 5% is optimal. And Morningstar also says that 2 to 5% is optimal. So most of these studies are saying that anywhere from 2 to 6% is the optimal amount to have in things like Bitcoin to benefit from dollar and other currency devaluation. Considering we're going into the third year of the cycle with Bitcoin, where we bottom in the first year and we top at the end of the third year, it may be a good idea to look at potentially decreasing a little bit, considering that Bitcoin may have become a bigger and bigger part of portfolios for clients. So heading into a recession, it may be better to allocate a little bit more toward bonds and gold. And this right here shows how allocating toward bonds and gold is done over time versus being in stocks heading into a recession. So if you're being tactical, you're going to overweight toward those types of things. If you're being tactical, you can notice here that Bitcoin tends to go up for 3 years and then go down in the fourth year. So if we've bought in the early stages and it's been going up for 2 years, we might have up to another year for it to continue going up. So somebody's wanting to be really tactical, maybe waiting a little bit longer. We want to be out if we're being tactical before we hit that fourth year, that's the down year. So what we want to consider is, if we know what we're doing, if people know what they're doing, they can be a little bit more tactical. If you want to eliminate more risk associated with not knowing what you're doing, you want to be more strategic. And keep remembering that risk, by some people's standards, is how much it goes up and down. But if we're looking at Warren Buffett, risk comes from not knowing what you're doing and buying at a price a lot higher than what something is worth. Please feel free to click on this video, which goes over a few more things like this, and share with your friends. Stay thirsty for knowledge. We'll catch up with you later.